Hey folks, welcome back to Real Estate Investing Unmasked. Today we're going to talk about an article I read from Bloomberg. So guys, I read this article and it says that 20% delinquency rates in New Jersey on FHA loans. That is crazy. That is really crazy. Now that's New Jersey. There are other places like New York and some other places I think were like 11% or 6%. There are conventional loans that also have high delinquency rates. That is actually really scary because if those houses, if Congress allows them to be foreclosed, meaning they don't provide some kind of stimulus to prevent foreclosure or eviction or whatnot from the basically 1 in 4 people that aren't working, there's going to be a lot of inventory that's going to be available. Now, are the banks going to sell them immediately, or are they going to hold on to them? The reality is the banks don't have, they lend out more money than they have. They have a ratio that they lend their money out. For instance, if I have $1 and I'm allowed to lend out $10 and I lend $10 out and I get a property back, that's not good. I'm only allowed to have so much property that I own. I have to have a certain dollar amount that I have available to be able to lend out money. And the banks have that. They have to get rid of these properties. I'm starting to feel like it's a 2008 moment again, 2007, 2008 moment again, where all these prices. Now, what I see here in California, I see houses that sold just 3 years ago, in some cases 4 years ago, for about $400,000, now selling at $800,000. They doubled in value in 4 years or less. That is an incredible amount of inflationary pressure on house prices here in Southern California. So either we're going to have some kind of inflation coming, or those house prices have to drop. The only reason why they haven't dropped yet is because they keep lowering the interest rate on what people can borrow to buy. And this is what happens. People buy houses based on the mortgage payment, not of the price, on the mortgage payment. So if you can get a mortgage and you can pay $3,000 a month, you're going to borrow whatever it is that you can borrow to hit that $3,000 a month. Well, if interest rates go up and that money costs more, then those house prices have to come down for you to be able to hit that $3,000 a month. But as interest rates go down, that means the house pricing go up and your mortgage payment just barely goes up as well. So right now we have artificially low interest rates. Matter of fact, interest rates are so low, they are below the inflation rate. Are we in a deflationary economy right now? I don't think so. I think we're in an inflationary economy. And when you have inflation, one of the ways that you curb inflation is to increase the interest rates, to slow down the borrowing, to slow down how much money is out there. Because when there's too much money for too few assets, that's inflation. And right now, that's what's going on. We have so few number of properties that are available, and we have tons of money that's been given out in stimulus and trillions of dollars, that right now you have too much going after too little. And if the economy kind of hits and kind of stutters, and there's a lot of property put out, now you have a lot of money going for a lot of assets. That lowers that inflation. But what that also does is it brings down the house price, because now supply, instead of being down here, is brought high. So high supply, demand has been about here the whole time. So low supply, high demand makes the prices go up. High demand, high supply, or higher supply causes the prices to either maintain the same or go down. If interest rates go up, the prices come down. Right now, because interest rates have gone down, prices have gone up. These are very basic economic knowns, because people, when they buy their house, they buy the mortgage payment, they don't buy the price of the house. Okay, yeah, they buy the house for, say, $750,000 or $1 million. But what they're really doing is they're locking in what they can afford each month. So if the interest rates go up, then the amount of price that you can buy based on your mortgage payment will have to come down. And so right now, I feel like we are still in a very high market, even higher than we were a year ago, when I said, you know what, it looks like we're probably going to see some kind of break next year in house prices. It didn't happen. Why didn't it happen? Because COVID came and it just destroyed everything. And because they were trying to make up for what had happened to business, a lot of money was forced into the markets via stimulus and other methods that have artificially held up the economy. So right now, it's really up to the government. Are they going to legislate and give more money to themselves? Or are they going to let the economy correct itself? And if they just give more money to themselves, what you're going to get is inflation. If they let the economy correct itself, then you'll see prices come down, interest rates will come up, and then you'll start to see that there will be a balance between supply and demand. But right now, it is just nuts. It is nuts out there. So I want you guys to be careful. Watch the economic news. The stock market has done amazing since March. I am hitting at a 42% return on my money as a whole. So it's about time that we realize and take a step back and say, whoa, let's not just legislate giving ourselves money. Let's pay attention to what's going on. For you as an investor, you got to pay attention to what's going on with the interest rates. Just last week, Fannie Mae and Freddie Mac said we're going to increase refinance fees. So every refinance starting September 1st is going to be 0.5% higher. So if you were going to get a 2.5% rate right now, well, if you close after September 1st, there's a 0.5% in their fee that you're going to be charged. Fannie Mae and Freddie Mac are doing a money grab. And so watch out for that. The last couple of years, they raised how much the PMI was going to cost, the mortgage insurance premium, the MIP. They raised how much that was going to cost. Instead of being like 0.75%, now it's like 1.25%. So the housing agencies are digging into your pockets because the interest rates are so low right now. As interest rates climb up, there's going to be some pressure probably for them to lower those fees, but I doubt they will. But if interest rates go up, you're going to see house prices come down. Or wages will have to go up. Wages will have to go up to compensate, to give some inflationary pressure. You're going to have inflation in order to meet the demand of house prices being super high and interest rates going up. And the Fed typically will use interest rates going up to curb those inflationary pressures. So the government usually is comfortable with about a 3% inflation rate each year, but I'm really worried we're going to go higher than that as soon as this COVID thing is figured out. So guys, be on the lookout, watch out, don't forget to subscribe, and I'll keep in touch.